You see, the market rarely shouts, it whispers. And most men lose money because they're waiting for noise instead of learning how to listen. Now let me ask you something. Have you ever looked at a chart and felt uncertain, as if price itself was hesitating? That pause you see, that moment where neither side seems willing to commit. That's where the Doji candle lives. A Doji is not just a candle. It is a condition. It is the market thinking. Now understand this clearly. When price opens and closes at nearly the same level, what does that tell you? It tells you that effort was made, but no progress followed. Buyers pushed, sellers pushed back, and in the end, neither side claimed victory. And when effort produces no result, something is building beneath the surface. Do you see the implication there? Most traders glance at a doji and move on. That is their first mistake. The doji is not important by itself. It is important because of where it appears. Location is everything in speculation. I learned long ago that a signal without context is just noise. So you must begin with observation. Not action, not prediction. Observation. When you spot a doji, ask yourself, where has it formed? Has the market been rising steadily, showing strength, confidence, almost arrogance? Or has it been falling, with fear pressing prices lower? Because when a doji appears after a strong move, it tells a very different story than when it appears in the middle of nothing. Let's take a rising market. Price has been climbing, higher highs, higher lows, and traders are growing comfortable. Confidence is dangerous in this business. Then suddenly, a doji forms. Now pause and think. If buyers were truly in control, why couldn't they close the price higher? Why did momentum stall? That's your first clue. It doesn't mean the market will reverse immediately. Markets don't reward impatience. But it does mean that something has changed. The certainty is gone. And when certainty disappears, opportunity begins to form. Now let me ask you, would you rush in at that moment, or would you wait? The inexperienced trader acts on the candle alone. The experienced trader waits for confirmation. Because one candle is a signal, but behavior that follows is the truth. You must watch what happens next. If the market, after forming a doji at the top, begins to move lower, then you have cause and effect. The hesitation turned into weakness. That is something you can work with. But if price continues upward, then the doji was nothing more than a pause, a rest before continuation. You see the difference? This is where discipline enters. Not every doji deserves your money. In fact, most of them don't. The market prints dojis all the time, but only a few occur at moments that matter. Your job is not to trade often. Your job is to trade correctly. Now consider the opposite scenario. A falling market. Price declining, sellers in control, pessimism spreading. Then a doji appears. What does that tell you? It tells you that sellers, who once had no resistance, are now meeting opposition. Their dominance is being questioned. But again, I ask you, does that mean you buy immediately? Of course not. You wait to see if buyers can follow through, because a single moment of balance does not create a trend. It only signals the possibility of change. And this is where most traders fail. They mistake possibility for certainty. The doji is not an instruction. It is a warning. It tells you to pay attention. Now let's bring this into practical terms. When you identify a doji, you should do three things. First, mark the level. The high and low of that candle become important because they represent the battle zone between buyers and sellers. Second, observe the next few candles, not one. A few. Markets reveal truth through behavior over time, not in isolated moments. Third, align it with the broader picture. What is the trend? What is the market trying to do overall? Because a doji against a strong trend is weaker than a doji that appears at exhaustion. Let me put it plainly, when you trade without context, you are guessing. And guessing is expensive. Now think about psychology for a moment. Why does the doji matter at all? Because it represents indecision. An indecision in the market reflects indecision in traders' minds. When traders are unsure, they hesitate. When they hesitate, volume can shift. And when volume shifts, price follows. Cause and effect. You must train yourself to see beyond the candle and into the behavior it represents. Because charts are nothing more than human nature recorded in price. Now here is something many won't tell you. Dojis are more powerful when they come after extended moves. Why? Because the longer a trend runs, the more participants are involved, and when those participants begin to hesitate, the effect is larger. A doji after 5 candles means little. A doji after 50 candles means something. Do you see how context builds meaning? And then there is patience. Always patience. You cannot force a trade out of a doji. If you do, you are trading your emotions, not the market. And the market has no sympathy for emotion. I made my money not by acting quickly, but by acting correctly. And correctness comes from waiting until the market proves your idea right. So when you see a doji, don't think of it as a signal to act. Think of it as a signal to prepare. Preparation is where the real work is done. Execution is easy once the decision is clear. Now let me ask you one more thing. How many times have you entered a trade because you felt something might happen, only to watch the market do the opposite? That is what happens when you act before confirmation. The doji teaches patience. It forces you to slow down. It reminds you that the market does not reward anticipation. It rewards alignment. And when you begin to understand that, when you begin to wait for the market to reveal its hand, you stop chasing and start positioning. Because the truth is, the money is not made in the candle itself. It is made in what follows it. The meaning of a doji is determined by its location, not its shape. That is something most traders overlook, and it costs them. They become fascinated with the appearance, the symmetry, the long wicks, the neat little cross, and they forget to ask the only question that matters: where did it form? Now think about it for a moment. What difference does a doji make if it appears in the middle of a quiet, directionless market? None. It is simply more indecision in a place already filled with it. There is no tension, no imbalance, no reason for price to move with purpose. Yet many traders see that candle and convince themselves something meaningful has happened. That is how the market takes their money. By letting them act where nothing is truly happening. But place that same doji at the top of a strong advance and the story changes entirely. Price has been rising, confidence is building, buyers feel in control. Then suddenly, the market stops progressing. It tries to move higher, it tries to move lower, and in the end, it finishes where it began. Now ask yourself, why would a strong market fail to continue? That question carries more weight than the candle itself. Because when a trend pauses after strength, it suggests that the force behind that trend is weakening. Not gone, not reversed, but no longer unquestioned. And that subtle shift is where opportunity begins to form. The same principle applies in a falling market. A doji after a prolonged decline is not just another candle. It is the first sign that sellers are no longer moving price with ease. It shows that pressure is being absorbed, and when pressure is absorbed long enough, direction can change. You see, the candle does not create the opportunity. The context does. The doji is only the messenger. Now let me ask you, would you treat every message the same? Of course not. A whisper in a crowded room means nothing. But a whisper in silence captures your attention. That is how you must learn to see these patterns. This is why you must train yourself to step back before you step in. When you spot a doji, don't rush to interpret it by its shape. Instead, study the path that led to it. Was the market trending with strength? Was it accelerating? Was it approaching a level where traders might take profits or reverse positions? Because when a doji forms at a point of decision, after a long move, near a key level, at a place where traders are likely to react, it carries meaning. It tells you that the market is no longer moving blindly. It is thinking. And when the market thinks, you must think with it, not ahead of it. Too many traders isolate candles from their surroundings. They treat patterns as fixed signals, as if the market follows a script. But the market is not mechanical, it is behavioral. It responds to pressure, emotion, positioning. And the same candle can mean strength in one place and weakness in another. Cause and effect again. A doji in a range means continuation of indecision. A doji after a strong move means potential transition. The difference is not in the candle, it is in the story behind it. And if you begin to read that story, if you begin to place each candle within its proper context, you stop reacting to shapes and start understanding behavior. That is when your decisions become grounded, not hopeful. When effort produces no result, something is changing beneath the surface. That is one of the oldest truths in speculation, and yet most traders fail to see it when it appears right in front of them. A doji is the clearest example of this principle. Price moves, buyers push, sellers respond. Activity is present and still, nothing is gained. Now ask yourself, how can there be effort without progress? In any market, movement requires participation. Orders are being placed, positions are being opened and closed, yet the final result shows balance. That tells you one thing: opposing forces are meeting with equal strength. And when strength meets strength, the outcome is rarely stability for long. You must understand this clearly. Trends move because one side is dominant. Buyers overwhelm sellers, or sellers overwhelm buyers. That imbalance creates direction. But when that imbalance begins to fade, when the dominant side no longer pushes price forward, you start to see hesitation. That hesitation is printed as a doji. So the candle is not the story. The story is the loss of control. Now consider a strong upward move. Price has been rising steadily, perhaps even aggressively. Each candle shows progress. Buyers are confident, maybe even careless. Then suddenly a doji forms. Price travels, but it returns to where it began. Effort without result. What does that tell you? It tells you that buyers, who once controlled the market, are now being met with resistance strong enough to stop them. Not reverse them yet, but stop them. And stopping momentum is the first step toward changing direction. But let me ask you, does that mean the market will fall immediately? No. And this is where traders lose discipline. They see the loss of progress and assume immediate reversal. But the market does not move on assumption. It moves on confirmation. The doji is the first signal that something has shifted. What follows determines what that shift becomes. Now flip the situation. A market falling hard, sellers in command, price declining with little resistance. Then comes a doji. Sellers push, but they cannot close lower. Buyers step in just enough to hold ground. Again, effort without result. This tells you that selling pressure is being absorbed. And when pressure is absorbed consistently, it weakens. Because if sellers cannot push price lower despite effort, then their influence is no longer absolute. This is how transitions begin, not with sudden reversals, but with subtle failures to continue. You see, most traders focus on what the market is doing. Few focus on what the market is failing to do, and often it is the failure that matters more than the action itself. A doji is a failure to continue, a failure to dominate, a failure to produce result from effort. Now think about cause and effect. When effort no longer produces progress, participants begin to question their positions. Buyers who expected higher prices start to hesitate. Sellers who expected lower prices begin to doubt. That hesitation spreads, and when hesitation spreads, volatility often follows. Because uncertainty invites movement. This is why the doji matters, not because of what it shows on the surface, but because of what it reveals underneath. It exposes a shift in conviction, and conviction is what drives trends. Without conviction, trends cannot continue. But again, you must remain disciplined. Not every instance of effort without result leads to reversal. Sometimes the market simply pauses, gathers strength, and continues in the same direction. That is why observation must come before action. When you see a doji, study the context, study the prior movement, study the reaction that follows. Because the first candle shows you the struggle, but the next candles show you who wins it. And that is where the real information lies. A doji after a strong trend carries more weight than one in a sideways market. That is not opinion. It is observation earned over time. The market only reveals its intentions when something meaningful is at stake, and strength is what creates that meaning. Now think about a sideways market for a moment. Price moves up, then down, then back again. There is no clear direction, no dominance, no urgency. In such conditions, a doji is simply part of the noise. It reflects indecision. Yes, but the entire market is already indecisive. So what has changed? Nothing. And if nothing has changed, there is nothing to act on. But place that same doji after a strong trend, after price has been moving with purpose, with consistency, with confidence, and now you have a different situation entirely, because trends are built on conviction. Buyers believe price should go higher, or sellers believe it should go lower. That belief drives participation, and participation drives price. So when that conviction begins to weaken, it does not go unnoticed. Let me ask you, what happens when a market that has been moving strongly suddenly stops progressing? Not reverses, not collapses, just stops. That pause is not random. It is the first sign that the force behind the move is no longer as strong as it was. And that is where the doji becomes meaningful. Because in a strong trend, continuation is expected. Momentum should carry price forward. So when a doji appears in that environment, when price opens, moves, and closes without progress, it contradicts that expectation. And when expectation is broken, traders begin to react. Buyers who are confident start to question. Sellers who are cautious start to prepare. The balance begins to shift. Now compare that to a sideways market. There is no expectation of continuation. Price is already moving without direction. So when a doji appears, it tells you nothing new. It does not challenge the current behavior. It simply confirms it. Do you see the difference? Meaning in the market comes from change, not repetition. A doji in a range is repetition. A doji after a trend is change. And change is where opportunity begins. But you must be careful. A strong trend does not end because of one candle. It weakens first. It slows down. It hesitates. The doji is often one of the first visible signs of that hesitation, but it is not the conclusion. It is the introduction. This is where patience separates the professional from the amateur. The amateur sees the doji and assumes reversal. The professional sees the doji and begins to observe more closely. Because what matters is not just the presence of hesitation, but what follows it. If the market, after forming a doji in a strong uptrend, begins to move lower, then you have alignment. The hesitation has turned into weakness. That is something you can act on. But if price resumes upward movement, then the doji was simply a pause, a brief moment of balance before continuation. And trends when strong often pause before continuing. Now consider why this happens. In a strong move, many traders are already positioned. Late participants enter near the top, driven by emotion. Early participants begin to take profits. These opposing actions create friction, and that friction appears as a doji. It is not random, it is the result of competing decisions. So when you see a doji after a strong trend, you are witnessing a moment where control is being tested. The dominant side is no longer moving freely, it is being challenged. And when control is challenged, the outcome becomes uncertain. This is why you must treat such dojis with respect. Not fear, not excitement, respect. They are not signals to act blindly, but signals to pay attention. They tell you that the market is no longer as one-sided as it was. Now let me ask you, would you rather trade in a market that is predictable or one that is changing? Because when a trend is strong, it is predictable. But when it begins to weaken, it becomes uncertain. And uncertainty is where both risk and opportunity increase. Your task is not to guess which one will win. Your task is to wait until the market shows its hand. Because the doji itself is only the moment of balance. The real move comes after that balance is broken. The candle itself shows hesitation, but the next candles reveal intention. That is where most traders lose their way. They see the hesitation and mistake it for a decision. But hesitation is not a decision. It is only a pause before one is made. Now think about this carefully. A doji forms, price opens and closes nearly the same, movement happens but goes nowhere. That tells you one thing clearly. The market is undecided. Buyers are not strong enough to push higher, sellers are not strong enough to push lower. It is a standoff. But let me ask you, can you make money from a standoff? Of course not. Money is made when one side takes control, and control is not shown in the doji, it is shown in what follows it. This is why the next candles matter more than the doji itself. The doji is only the question. The following price action is the answer. You must train yourself to wait for that answer. Now consider what happens after a doji in a rising market. Price has been moving upward, then suddenly it pauses. The doji prints. At that moment the market is balanced, but balance never lasts long. One side will step forward. If the next candles begin to move lower, closing with strength, then you have your answer. Sellers have taken control. The hesitation has turned into weakness. That is not guesswork, that is evidence. But if the next candles push higher, breaking above the Doji's high, then buyers are still in charge. The pause was temporary. The trend continues. You see the difference? The Doji tells you to pay attention. The next candles tell you what to do. Now let me ask you, how often have you entered a trade based on a single candle, only to watch the next few candles move against you? That is what happens when you act on hesitation instead of intention. Because hesitation can resolve in either direction. It carries no commitment, and without commitment, there is no edge. The market does not reward those who anticipate. It rewards those who align. This is where patience becomes a tool, not a burden. When a doji appears, your job is not to predict the outcome. Your job is to observe the reaction. Watch how price behaves immediately after. Does it move with strength? Does it hesitate again? Does it break the high or the low of the doji? These are not small details. These are the clues that reveal control. Because when price breaks above a doji's high with conviction, it shows that buyers have overcome the balance. When it breaks below with strength, it shows that sellers have taken command. That break is intention made visible, and intention is what you trade. Now understand this, markets move from balance to imbalance. The doji represents balance. The move that follows represents imbalance, and imbalance is where profit is made. But you cannot skip the process. If you act before imbalance is confirmed, you are trading in uncertainty, and uncertainty is where losses accumulate. Cause and effect again. When you wait for confirmation, you reduce uncertainty. When you reduce uncertainty, your decisions become clearer. And when your decisions are clearer, your results become more consistent. This is not about being slow. It is about being precise. Many traders believe they must act quickly to capture opportunity, but speed without clarity is expensive. The market will always provide another opportunity, but it will not forgive poor decisions. So when you see a doji, do not rush. Mark it. Observe it. Let the market reveal its intention. Because the real move, the one worth your money, does not happen in the moment of hesitation. It happens in the resolution of that hesitation, and that resolution is always written in the candles that come next. Never trade a doji alone. Wait for confirmation through follow through. That is not caution for the sake of caution. That is survival. Because a doji, by its very nature, represents indecision. And indecision is not something you build a position on. Now ask yourself, if the market itself is uncertain, why would you choose that moment to be certain? That is where most traders go wrong. They see the pattern, they recognize the shape, and they act as if the outcome is already decided. But the doji has decided nothing. It has only paused. You must understand this: a single candle does not control the market. It reflects a moment within it, and moments pass quickly. What matters is what follows, what develops from that moment. This is where confirmation enters. Not as a luxury, but as a necessity. When a doji forms, it tells you that balance exists. Buyers and sellers are evenly matched, but balance is temporary. One side will eventually gain control. The question is, which one? And that answer is never found in the doji itself. It is found in the follow-through. Now let's make this practical. You see a doji after a strong upward move. The inexperienced trader sells immediately, expecting a reversal. But what happens if the next candle moves higher? What if buyers step back in and push price upward with strength? Then the doji meant nothing for reversal. It was only a pause, and the trader who acted too soon is now on the wrong side of momentum. Cause and effect. When you act without confirmation, you expose yourself to unnecessary risk. When you wait for confirmation, you align yourself with the market's decision. Now consider the proper approach. A doji forms. You take note. You mark its high and low. Then you wait. You observe the next candle, and the one after that if necessary. You look for commitment. If price breaks below the doji's low and continues downward, then sellers have taken control. That is your confirmation. If price breaks above and holds, then buyers remain in charge. This is not complicated, but it requires discipline. Let me ask you, why is it so difficult for traders to wait? Because waiting feels like missing out. It feels like the opportunity is slipping away. But in truth, the real opportunity only begins once direction is clear. Before that, it is only speculation. And speculation without evidence is nothing more than gambling. The market does not reward the first to act. It rewards the one who acts correctly. And correctness comes from confirmation. Now understand something else. Confirmation does not eliminate risk. Nothing in this business does. But it reduces uncertainty. It shifts the odds slightly in your favor. And over time, that slight edge is what separates profit from loss. A doji alone offers no edge. It offers a possibility. But possibility is not enough. You must wait for proof. And proof comes in the form of follow-through. Strong candles, clear direction, continuation beyond the doji's range. That is the market committing. That is where you step in, not before. Now think about behavior. When traders see a doji, many of them act immediately. They anticipate the move. They try to be early. But early often means wrong. And being wrong early leads to losses that could have been avoided with patience. Because when you wait for follow-through, you are no longer guessing. You are responding. There is a difference between anticipation and reaction. Anticipation is based on what you think will happen. Reaction is based on what is happening. The market respects reaction. So when you see a doji, remind yourself, this is not the moment to act. This is the moment to prepare. Watch closely. Let the next move unfold. Let the market reveal its intention. Because the candle may show hesitation, but only the follow-through shows commitment. The high and low of a doji define a temporary battlefield between buyers and sellers. That range is not just a pair of prices. It is a line drawn in the sand. Within it, balance exists. Outside of it, control is decided. Now think about what happens during a doji. Price moves up, it moves down, but in the end it returns close to where it started. That means both sides have tested each other's strength. Buyers tried to push higher, sellers pushed back. Sellers tried to push lower, buyers absorbed that pressure. The result is a range, the high and the low of that candle. That range is where the fight took place. And let me ask you, when a fight ends without a winner, what happens next? It continues. But this time, one side will eventually gain the upper hand. That is why the high and low of a doji matter. They mark the boundaries of indecision. Inside that range, neither side has proven dominance. But once price moves beyond it, that balance is broken. And when balance breaks, movement follows. Most traders ignore this. They see the doji as a shape, not as a structure. But the structure is where the real information lies. Because those levels, the high and the low, become reference points. They tell you where buyers failed and where sellers failed. Now consider this carefully. If price breaks above the high of a doji with strength, what does that tell you? It tells you that buyers have overcome the resistance that previously held them back. They are no longer being matched. They are in control. That is not hesitation anymore. That is decision. On the other hand, if price breaks below the low of the doji, sellers have taken command. The support that held price steady has given way. The balance has shifted. Do you see how simple it becomes when you look at it this way? You are no longer guessing. You are observing who wins the battle. But here is where discipline matters. Not every break is meaningful. The market will often test these levels, move slightly beyond them, and then return back into the range. That is false movement, noise designed to trap the impatient. So you must ask yourself, does the break show conviction? Is there follow-through? Does price continue beyond the level, or does it hesitate again? Because a true break does not struggle, it moves with purpose. Now let me ask you, how often have you entered a trade the moment price touched a level, only to see it reverse? That is what happens when you treat levels as triggers instead of zones of decision. The high and low of a doji are not commands to act. They are areas to watch. They tell you where the market must prove itself. And proof is everything in trading. Now think about psychology again. Traders who bought within that doji range are uncertain. Traders who sold within that range are uncertain. When price breaks out of that range, one group becomes uncomfortable. They begin to exit. And those exits fuel the move. Cause and effect. A breakout is not just price moving. It is traders reacting. It is positions being closed, new positions being opened, momentum building. This is why the doji range matters. It is the point where tension builds, and the break is where that tension releases. But you must remain patient. Let the market show its hand. Let it move beyond the range and hold there, because strength is not in the break alone, it is in the ability to stay beyond it. If price breaks above and quickly falls back, buyers were not strong enough. If it breaks below and returns, sellers failed. Failure at these levels is just as important as success. Indecision in price reflects indecision in traders' minds, and that often precedes movement. The chart does not move on its own. It is driven by people, by their expectations, their fears, their confidence, and their doubt. So when you see a doji, you are not just seeing a candle. You are seeing hesitation in human behavior. Now let me ask you, what happens when a group of traders becomes uncertain? Do they act boldly, or do they hesitate? Of course, they hesitate. They begin to question their positions. Buyers wonder if they are too late. Sellers wonder if they are too early, and that hesitation slows the market down.